Welcome to Be the Boss of Your Money. I'm Mitch Goldberg, your host. You're watching my live stream. It's all about personal finance, covering things like investing, borrowing, credit, college loans, retirement planning, investment planning, income planning, you name it, we talk about it right here. This show is all about financial education, and I want you to pay attention. We've got some important things to talk about today. The stock market finally finds some semblance of balance. The housing market. I want to show you a few stats of why I think it pays to expect housing prices to keep on going up, regardless of minor changes to interest rates. And we're going to talk about the most important story that I think that happened this week so far is Jerome Powell, chairman of the Federal Reserve, has come out and assuaged, calmed markets by saying, I really do think inflation is transitory and we're going to be very patient. And that takes off a couple of worries off the weight on the market. So we're going to get into this. We've got a good show today. I want you to stick around. And when we come back, I'm going to just roll a quick intro. We're going to get into it. And if you have any questions, certainly ask me in the comments below. And if you're watching this in the replay, welcome to you as well. So here we go. Let's roll the intro and get ready for a good show. Buckle up. Hello, it's Mitch Goldberg here. Welcome to my live stream. If you're just joining us now, we're talking about the Federal Reserve. We're talking about inflation. We're talking about the market today, some balance. I made a little change in one of the watch lists that I'm going to show you, the FANG M watch list. I changed the N from Netflix to NVIDIA. NVIDIA is more than twice the size of Netflix. And I don't think Netflix is really the powerhouse it used to be. Don't get me wrong. It's a powerhouse in entertainment, streaming, and all that. That hasn't changed. But as far as a leadership stock goes, it's just not doing it for me anymore. So we'll go through that. Also, we've got a few people out there. Jay, I see you out there. Thank you very much. And thank you very much for your help the other day with the audio problem that I was having with my live stream. So I had two snafus last week. The first one was I was supposed to have a guest, Christine Lucan, on, and I had some audio problems, and the audio issues got even worse the next day, and nobody could hear me. So I'm doing this live stream, doing that, and doing this, and talking, and going from camera to camera, different views, and I'm going on and on. Nobody could hear me. So I figured I'll keep on going because when I live stream, I record all the shows in an MP4 file, and even the MP4 file was silent, and I was bummed because I felt like I put a really good show on. Maybe I'd be better off just doing YouTube videos and without having a live audience. Now, I like this. It's kind of exciting for me. I get a little excited. I go live and it's a big deal, and you trip over your words. You do things like you sneeze or you cough, or once I was drinking some water and I started hacking and coughing because I inhaled it. And that was like, people watched me for like 4 minutes just coughing my brains out. But that's the beauty of live, and it's a lot of fun, And yes, thank you, Jay. We can hear you now. Can you hear me now? Isn't that the Verizon commercial? And then actually that actor went to AT&T. So let's keep going. We're going to roll a couple of things here. We're going to start with a share screen, but first let's have an oh yeah for balance in the stock market. You ready?
Oh yeah.
Oh, yeah. Okay. So let's just do a quick share screen. Let's see how this all works. And there's a couple ways to share a screen. I said to you guys, like the last 2 weeks, I'm getting a new computer. I ordered the computer. It's a very high-end computer, much better than the one I'm using now. The computer I have now is a really good computer when I bought it. But when I bought it, I actually I never intended to live stream and do the amount of video editing that I do. And the computer I'm using right now, it just doesn't cut it. It's as far as live streaming and video editing. it's just not made for that. And I put a 2 terabyte hard drive into this computer, and I've already almost used it up completely. And it's got like don't laugh at me, eight gigs of RAM. I mean, it's just not cutting it. The new one is 16, but it's got a separate gigs of RAM just for video and all that good stuff. Okay, so let's just share the screen and hopefully this will work out. Well, yes, it's working. It's working. So here's NVIDIA. The stock is right near its all-time high of 775. Stock is up over 45% year to date, but its market cap is $474 billion. You see that? $474 billion. Let me make this a little bigger so you could see this on your smartphone. I know all you guys are watching this on a smartphone. Okay. So it's $474 billion. Oh, here we go. Now it's expanded. So $474 billion. Netflix is like $227 billion. And it's just, Netflix is not the streaming powerhouse it was. It's a powerhouse in its own right, but now it's competing against others like Disney Plus. So let's take a look at the U.S. markets. The Dow is off 71, off, that's 0.21%. Big deal. NASDAQ was up 0.13. S&P was barely off, down 0.11. This is about as flat of a day as we've seen in a while, folks. So, everything up a tenth or 0.2 or down. Everything is between a tenth and 0.2%. This is, as far as I can tell you, as far as I'm concerned, this is the kind of day I like. Boring, gives you a chance to catch up. Making investment decisions in times of volatility, I don't think is very helpful. I personally, I like to be able to think clearly about what I'm doing and get ready in advance of volatility, which is always where I am, by the way, and where my clients are. Gold off barely, but inflation worries, which picked up last week because the chairman Jerome Powell said, "Hey, we're moving up our target to tapering and interest rate hikes, maybe in 2023." Then the president of the St. Louis Federal Reserve Bank branch says we might have interest rate hikes next year. James Bullard does that a lot, by the way. He comes out with hawkish messages, and then he disappears, and nothing ever happens with his opinion or anything. Nobody ever acts on it. Nothing. It doesn't change anything. He's not even a voting member this year of the Federal Open Market Committee, which is the part of the Federal Reserve that votes to lower or taper or whatever with interest rates and quantitative easing, buying bonds and all that. But oil continues its move up. How far could oil go? In 2008, right after Lehman Brothers failed, it was a weird time. The economy was going deep dive into a really bad recession, the Great Recession, the worst economic calamity since the Great Depression, government bailouts galore. And with that, you think, the economy slowing, deep recession. Oil went up to $147 a barrel. So if we just do what we did 13 years ago, oil is $147 a barrel. I can't believe it was 13 years ago already. And the 10-year Treasury, just want to highlight this, it continues to be under 1.5%. It went out today at 1.48%. What happened to that 2.5% quick forecast? So I was in that camp earlier this year, and I'm thinking, yes, the 10-year Treasury could go to 2.5% this year. But now that June is like almost over, it would really surprise me if the 10-year Treasury gets to 2.5%. I'm pulling in that forecast. If you recall, about 3 or 4 months ago, the 10-year Treasury is up to 1.75, 1.77%, and people were really getting ready for, an inflationary environment. But as soon as Jerome Powell and the Fed, as soon as they spoke last week and said, we might bring in our forecast, make it closer to tapering, in other words, slowing and then stopping their bond purchases. It reminded people that, the Fed is watching inflation. I think investors got a little bit too complacent and said, the Fed's not going to do anything. And that's the bond market. And the VIX is down again, down to the 16. So not a lot of fear. And I right now I'm expecting just a general drift higher. The other day, let me just take a look at the Russell 2000. That was up 0.33%. So not up a lot, but 0.33 is better percent. See this 0.33? It's better than the other indices. Commodities, wheat goes up, soybeans down, corn down. Currency, well, I want to look at lumber, but let's take a look at lumber. Let's see if we could just pull a separate chart up for that. Here we go. Lumber down 1.25%. Take a look at a chart for the last year. Lumber is really, $879. So it's still up a lot this year, but it's down to $879 from up here, like 1,600 and change. Basically, the price of lumber has been cut in half in just like the last 5.5, 6 weeks. That's pretty significant. Now it's still up a lot in the last year. I'm not doubting that at all. Okay. A year ago it was 430. So it's still doubled in the last year. That's a huge move. But come on. Things, a lot of commodities are coming down strictly because the Fed says they are ever so slightly hawkish, so slight, it's barely hawkish, meaning, when the Fed's hawkish, that means they're watching out for inflation. And that's what happened. So let's keep moving on. Let's take a look at the watch list. Okay, so FANG overall had a mixed day. NVIDIA up a little, Facebook up a little bit. Facebook continues to stay at its all-time high. Microsoft hit $2 trillion valuation. Google's up. The FANG M stocks, these are the heavyweights. These continue to do well. Apple is off a little bit from its all-time high. Nothing crazy, but if you look at these lines that I'm showing you here, where the triangles are still mostly very close to their all-time highs. So, how could the market not do well when these stocks, these giant market cap stocks, are doing well? You just remember, the S&P 500 doesn't necessarily measure the economy. It measures the performance of the largest stocks. And if the largest stocks are doing well, the S&P 500 goes up. The economy could go into a recession like we saw last year, but the S&P 500 did well because this handful of stocks did so well, and they're so big, they have such clout in the market that they pulled the S&P 500 along with them. Right? I want to show you the significant news of the day. 10-year Treasury yield flat following Powell's reassurance on inflation. You don't see that on your screen. Did you see this? Did you see that? You saw that. But I want you to see this one. All right, here we go. Now you see it. All right. 10-year Treasury yield flat following Powell's. That's not gonna happen when I get my new computer. By the way, it'll go a lot faster. 10-year Treasury yield flat following Powell's reassurances on inflation. U.S. Treasury yield saw a little movement on Wednesday, but Powell came out and said, hey, you know what? We're not going to really do much. He said it's very, very unlikely that the U.S. would see a repeat of 1970s style inflation. Can we talk about 1970s style inflation and that era of stagflation in the 70s? I remember still somewhat vividly being a little kid in the back seat of my parents' car with my brother when my dad would take us with him to the gas station, and we'd be online to get gas for, I don't know how long, it seemed like forever, but probably well over an hour, because it was hard to get gas because of the Arab oil embargo, or should I call it the OPEC oil embargo. And that's really what started the inflation of the 1970s. And it was squelched in 1980, or began to be squelched in 1980. And the reasoning goes that the chairman of the Federal Reserve back then, Paul Volcker, who, by the way, was appointed by President Jimmy Carter, he raised rates substantially, threw the economy into a deep recession in the early 80s, crushed demand, prices went down, and they've inflation has been coming down ever since. So it's 41 years later. But there's something else that's not spoken enough about that particular era. The PC, the personal computer, was just beginning to become broadly adopted, broadly used by businesses. And the PC is the greatest innovation, the greatest productivity tool ever introduced to the world of business, to the global economy. And I personally believe it was the introduction of the PC and all of the efficiencies that come out with computers and automation from semiconductor chips, advances in software. That's what crushed inflation. I don't really, looking at the history, I don't think Paul Volcker had to crush the economy by jacking up interest rates. I think it was the PC. It was innovation that brought inflation down. And then it continued into the 90s with the advent of the internet, and it continued into the 2000s as networking became more and more prevalent. And it's continued till now. This is one reason why I don't think inflation takes a big jump. Unless you think the computer's going away and the internet's going to get slower, and computers are going to get slower, and broadband is going to get slower. If you think all those, then we'll see a rise in inflation. But I think just everything gets faster. Automation comes at us faster. And I think that's the real reason why inflation stays low. Now, there's a lot of bottlenecks, supply bottlenecks. Demand globally is recovering much quicker than supply because, demand leads supply. No manufacturer wants to increase supply until they know that they have demand to soak up the supply. So that is what I'm thinking, and that's why I'm not so worried about inflation, and I don't think we have 1970s style inflation. Okay, so the last thing I want to point out, James is out there. Great chat on inflation. Hey, thank you very much, buddy. I really appreciate it. How does inflation affect the economy of Australia? Because Australia is I think Australia is the biggest producer of ore and gold and other commodities, right? Australia is a huge commodities producer. I would think that when there is inflation in commodities, that it could benefit the Australian economy, right? Of course, if you're having a trade war with China, that's a whole different story unto itself. We'll have to get into that one of these days. So here's what I want to show you, and I think this is pretty significant. Let me just pop myself back up in the corner. Population by age group. The oldest state, the state with the highest percentage of people over the age of 65 is Maine. Then you come down to Florida. Puerto Rico is a very small population. Yes, I realize Puerto Rico is not a state. But this is the information I'm getting here, okay, on this website from Kaiser. Okay. But there's growth. And if you go by the states with adults between 26 and 34, that's important to know because the prime home buying age is around high 20s to let's say high 30s, but this gives you 26 to 24, 26 to 34. Yeah. So Colorado, Alaska, Washington, North Dakota, California, New York. I think you could use this as a predictor of which states are going to see rises in home prices because that's the prime group. That's the age group that wants to buy houses. And since there's more millennials now than baby boomers, baby boomers sent housing prices soaring in the 80s and 90s. And I think that's what the millennials do, but they do it even more so. And they are doing it more so. So as percentage of the population, though, I want to show you this. I don't know if you could see this on your screen. Let me see if I can make this a little bigger. I could make it a lot bigger. Okay. All right. But the population in the United States population, check this out. The largest group was adults aged 22 to 29. That's, there are more people now in that age group than any other age group. if we were talking about 5-year increments. And that just goes to show you where I think the housing market goes. So I am not convinced that a housing wreck or a housing market crash is lurking behind the next corner, because people like to think this, in terms of that, hey, something's going to end, something's going to break. We're just going to go around the next corner and bam, Fed's going to raise rates, or there's a policy mistake, and housing's going to crash. The banks are going to go bust again. They're all going to have to be bailed out, or the stock market's going to have another 50% correction and stay down this time. And there's always an emergency that's imminent. Look, we don't know what the black swan events are, but the things that I just spoke about are not black swan events, because if we're talking about it, if we can conceive it, then it's no longer a black swan event, right? But this is why I think housing stays strong. And I think the demand for stocks and other financial instruments continues to stay strong, because the millennials who were really delayed by the Great Recession in terms of their in terms of growing their financial wealth have now not only caught up, but it's like they have pent up demand, and they're in a rush to get the 2 cars in the driveway, the house, the 2 or 3 kids in the house, the jobs or promotions, and upper management, CEOs, and all that. And it's happening. Make no mistake, it's happening very, very quickly. So there's just we could talk about the ramifications of that all day, but that's where we are. Wait a minute? Did I show you this? So here it is. If you didn't see it, I think I showed it to you, but here it is. Just make sure you could see that. Okay, the largest age group was adults age 25 to 29, and if you go from 30 to 34, then you definitely have the biggest age group. There's more millennials now than there are baby boomers in the United States. Thank you, James. James says inflation is high here at the moment. Plus, it's winter. It's winter, and you guys, are you guys out of the shutdown yet? I know we're out of the shutdown and then back into the shutdown. Hope you guys are safe and healthy, everybody in Melbourne and throughout the whole country, and hope everybody's getting their vaccines. Okay. I got mine. My whole family, we're a family of 5. We all got our vaccines. 4 of us got the Pfizer vaccine. 1 of us got the Moderna vaccine. We're all fine, and reactions to it were very little. So what else do we have to talk about? Okay, so we've been talking about cyclical stocks versus, the technology growth companies, the secular growers of technology that should grow no matter what. And then we talked about a few weeks ago that, hey, these cyclical stocks have gone too far. And then people started to worry a little bit about the economy because the yield curve flattened, and maybe they've just gone too far, even if we have as strong of an economy as we all expect to have. And then they backed off. And then now we talked about, there's some of these tech stocks. Remember, I did a live stream about DocuSign, Zoom, Teladoc, and a bunch of other really hot stay-at-home, work-from-home pandemic stocks. And we talked about buying those. They took off again. They did phenomenally well. And the one I spoke most about was DocuSign. It was like 180, 190, and now it's in the 270s. This is like what, in like the last 4 weeks. But this is why I always say it's important to have both the tech stocks and the cyclicals, because they switch off. And for diversification, you want both, and maybe rebalance between the two. These are more of questions about asset management, portfolio strategy, personal finance. But that's what we had been talking about. So, and now it looks like the tech stocks have gone not all the way back. Yeah, some of them are hitting highs, like Facebook, but a lot of them are not hitting highs. I know NVIDIA also is hitting highs, but they've come up. The cyclical stocks, bank stocks went down a little bit, and now they're starting to recover. And to me, it appears that the stock market right now it's a very sensitive, delicate balance that could really change very quickly either way, in terms of the inflationistas win, the people who are betting on inflation and stocks head south, or, the inflation transitories are betting that inflation heads back down. I'm going to give you the compromise of where I think inflation is going. So this is where I think inflation is going. I think inflation continues. I continue to believe inflation that we're seeing now is transitory. Inflation, cost of goods and services might not go back to what they were at the bottom of the pandemic or in 2019, but they certainly are still, in my opinion, too high. The scenario that I think we have is inflation is transitory, but transitory for a long period of time, which maybe means inflation isn't so transitory. You could say it's sticky, but not sticky for long, which keeps the Fed mostly on hold. So when you hear that the Fed could raise interest rates and taper its bond buying program, we're talking about things that are going to go very slow, that are a year or 2 or 3 years in advance into the future. And when the Fed does raise rates, I don't know if it's really something that people should be so scared about. Where could rates go? 0.5%, 1%, 1.5% on the Fed funds rate. I don't think these things are really the kind of things that are going to squelch the economy, domestically or globally. So that's my consensus in my own head. If it's just me agreeing with myself, does that actually make it a consensus? If I just say me, myself, and I, that's 3 people right there. That's a consensus. Or is it just like a split personality? I don't know. Okay. I'm going to get going. I have a few things to ponder. I'll be back tomorrow. And I really appreciate you spending some time with me.